Okay, next we're going to build the final of the three statements, and that's going to be the statement of cash flows. And that will effectively wrap up the historical section of this information. After this, we're going to move towards the projection, which is really the ultimate purpose of this exercise. So the first thing we're going to do is just update the name of our file to save our progress. We're going to call this part 2. SCF for statement of cash flows, and then we'll just shorten this to be part 1. So we'll divide this into 2 parts. Okay, so the first thing we're going to do is just copy our balance sheet header down to create a new section and call it statement of cash flows. Now, as you may recall from an accounting class you have taken in the past, or if you haven't taken an accounting class, to create the statement of cash flows, all you need is the income statement and the balance sheet. And this statement can actually be a little intimidating to create, and oftentimes businesses won't have one as part of their financial reporting system, but it's actually fairly easy to create once you know how to build it. So we're just going to start with the cash from operations for the first video, and then in the next video we'll get to the cash from investing and the cash from financing, and then how to link it all together. So the first section of the statement of cash flows is the cash from operations. And this will basically show what is the cash impact of a business that reports in accrual-based accounting, and that's what this business does. So this will measure the income, take out the depreciation because it's non-cash, and then it will reflect the change in the current assets and the current liabilities. So let's start from the top. The first item that we're going to bring in is our net income. And I'm going to go over here and link to that. And you'll notice I'm starting this in February because the statement of cash flows is designed to calculate the change in accounts between 2 periods. And we don't have any information for December of 2014. So we're going to start in February, and then I will leave the January 15 column blank. So this will be equal to the net income. Next will be our depreciation. And the reason we add this to our statement of cash flows is because the depreciation is a non-cash expense, and we are trying to figure out cash. Next, we're going to do the change in our current asset and current liabilities account. And we're going to make a dynamic formula in order to do that. So you can actually create formulas in Excel that have words contained in them, and they will still change when you move the formula around. And you do that by using the quotation marks. So I'm going to say equals quotation change in, then quotation mark, and then the ampersand sign, and link to the account I want to use, which in this case is going to be accounts receivable. So now all I have to do is press Control D to drag this down, and it says change in inventory. Do it again for change in prepaid expenses. Then I will do it again. You'll notice it says fixed assets. I'm just going to adjust the Excel row down to accounts payable. And then drag it down one more time, and we have our accrued expenses. So for any current asset, or any asset for that matter, it's going to be equal to the previous period minus the current period. So we're going to be saying equals the accounts receivable from the prior period minus the accounts receivable for the current period. And you can remember this in any way that you'd like. The common explanation in an accounting course is that if an asset goes up, that means cash went down because you had to spend cash to acquire that asset. And contrarily, when a liability goes up, you are effectively getting the benefit of something today that you don't have to pay for in cash until the future. So the 2 formulas that we're going to build, they will reflect those explanations. So we're going to just drag this down for the inventory, and then drag it down again for the prepaid expenses. Now we're going to switch the formula around for the accounts payable. So that will be equal to the current period minus the previous period. And then we will drag this down one last time for our accrued expenses. So the cash from operations is going to cover the income and the depreciation, and then any change in your current assets and current liabilities. So if I press Control open bracket, I can see that I've used my accounts receivable, and that Control open bracket helps me trace the formula. and then I press F5 enter and I can go back to where I came from. Control bracket again on the inventory. I've used that up. The prepaid expenses, I've used that as well. The accounts payable, as well as the accrued expenses. So if I look up at my balance sheet here, I can see cash is left, but that won't make its way down to the cash flow statement. We will ultimately be linking to cash when we get to the forecast period. So this is left out for now. Fixed assets, which I know is not a current asset, so I know that goes in a different section. Debt, which I know is not a current liability, so that also will go in a different section. And then the contributed capital and the retained earnings will also go in a different section. So I now know that my cash from operations is complete. So I'm going to just sum it up here. Total cash from operations. And then to create a quick sum automatically in Excel, I just press Alt equals, and Excel will assume the numbers that I want to include, and it assumed it correctly. And now our cash from operations is done. I'm just going to indent the line items underneath the header to help me stay organized. In the next video, we'll go through the cash from investing as well as the cash in financing and how to link it all together.